All right, let's dive into one of the most interesting stories playing out in the market right now, AppLovin. Now, these guys just dropped a monster earnings report. I mean, a total blowout by any standard. But the way the market reacted, well, let's just say it was not what anyone expected.
And that brings us to the big question, the central mystery we're going to unpack. How in the world does a company post these incredible, record-shattering numbers and then watch its stock get absolutely hammered by 20%? It's a total paradox, and it has the bulls and the bears in a serious showdown.
So here's how we're going to figure this out. First, we'll look at the paradox itself. Then we're going to step into the ring for round one and hear from the bulls. After that, it's round two, where the bears get their say. And finally, we'll pull out the scorecard and see which argument really lands the winning punch.
Okay, let's get right into it, and first up is the bull case. I mean, to really get why so many people are bullish on AppLovin, you just have to look at the raw numbers. And frankly, they're just an overwhelming display of financial power.
It all starts with revenue. The company raked in $1.66 billion in the fourth quarter alone. That is a 66% jump from the same time last year. Look, this isn't just some steady, nice growth. This is pure hypergrowth, and it's all being powered by their AI ad tech.
But here's what might be even crazier, their profitability. For the entire year, their adjusted EBITDA margin was an unbelievable 82%. Now that's just a fancy way of measuring core profit, but to put it in perspective for you, those are the kinds of elite margins you see from top-tier software companies. It's just incredible.
And all of that incredible profit, well, it turns directly into cold, hard cash. We're talking almost $4 billion in free cash flow for the year. That's the actual cash left in the bank after all the bills are paid. This company isn't just a business, it's a cash machine, plain and simple.
And believe me, the good news doesn't stop there. They didn't just meet earnings expectations. They completely crushed them. They spent over $2.5 billion buying back their own stock, which is a huge vote of confidence. And they told the market that this hyper-growth is going to continue into next quarter. The secret sauce behind all this? It's their AI engine, Axon, which acts like a competitive moat, protecting them from the competition.
Now, in the software industry, there's this really useful benchmark called the Rule of 40. It's pretty simple. You just add a company's revenue growth percentage to its profit margin percentage. If that number is over 40, you're generally looking at a very healthy, high-performing business.
So, what's AppLovin's score? 150. No, you didn't mishear that. 150. They aren't just passing the Rule of 40, they're nearly quadrupling it. A score like this puts them in a completely different league. It's the absolute cornerstone of the bull case. So with numbers this good, what could possibly be wrong?
Okay, so if the fundamentals are that strong, where on earth is the bear case coming from? Well, this is where it gets interesting, because despite that incredible performance, the market unleashed a storm of negativity. And the big question is, why?
This chart, this basically tells the entire bear story in one image. The stock just fell off a cliff. The market's gut reaction was a huge thumbs down. Bears are arguing this isn't just a random dip. It's a sign that the stock was priced for absolute flawless perfection, and anything less, even a stellar report, was going to be seen as a failure.
A huge piece of this negative narrative is this idea that growth is slowing down. See, on the surface, the guidance for next quarter was only 18% growth. And yeah, coming from 66%, that looks like hitting the brakes hard. But, and this is a big but, that number doesn't tell the whole story. It doesn't account for businesses they sold off. When you adjust for that, the real growth forecast is actually closer to 53%. But in a nervous market, it's that scary headline number that tends to stick.
And it's not just about the guidance. The bears will tell you there's a whole storm of external pressures. You've got giants like Meta and Google breathing down their necks. You have short sellers publishing negative reports. For some, the valuation at 37 times free cash flow just feels too rich. On top of that, when a competitor like Unity has a bad quarter, it tends to drag the whole sector down. It was just a perfect storm of negativity.
And the final nail in the coffin for some investors? The company decided not to give a forecast for the full year. In a market this fast-moving, that lack of a long-term roadmap creates a ton of uncertainty. And if there's one thing the market absolutely hates, it's uncertainty. So, that brings us to the final round. It's time for the scorecard. We need to weigh the hard, concrete numbers of the bull case against the fear, the uncertainty, and all the external risks that are driving the bear case.
And this scorecard really lays the conflict bare. When it comes to the hard numbers, growth and profitability, the bulls just dominate. It's not even close. The bear's main argument on growth is pretty weak, since it's based on that confusing guidance number. But the bears do land some solid punches when it comes to the softer stuff, that high valuation, the very real risk from competitors, and of course that powerful negative market reaction.
So, when we add it all up, based on the strength of the evidence in our source material, the final score is pretty clear. The bull argument comes out on top with a strength of 4.1, while the bear argument scores a 3.1.
So, what's the verdict? Here's the bottom line. The bull case is built on a foundation of solid, measurable, fundamental data. The bear case, on the other hand, while it has some valid points, really leans much more heavily on things like market sentiment, external worries, and just the general perception of risk.
Which leaves us with one last big question. Is this whole story just a classic battle between rock-solid fundamentals and powerful, emotional market sentiment? And if it is, which one is going to win in the end? That's really the billion-dollar question that everyone is trying to answer.